Thank you to everyone who has signed up and who is attending now. I'm delighted to introduce myself. I'm Callum Woodcock. I'm the CEO of WineFi. I'm joined today by our Head of Investment, Matthew Small, and our Head of Data and Analytics, Aaron Amelie Daniel. We will be presenting today on our latest fine wine investment syndicate, the imaginatively named Domaine de la Romanée-Conti collection, or the DRC collection for short. For those who are not familiar with this particular producer, DRC wines are widely regarded as the most sought after in existence. We offer investors the ability to co-own a diversified portfolio of DRC wines from as little as £5,000, and to put that into perspective, a single bottle of their flagship Grand Cru can cost upwards of £20,000. So it's a very good use of a syndicate structure. This presentation will run through market conditions, the characteristics of fine wine as an asset class more generally, and then we'll deep dive into this particular investment opportunity and our data methodology. Please feel free to ask questions in the chat as we go along, and we'll also hold a Q&A at the end, so we will be able to answer any further questions that we don't cover off during the core presentation. Without further ado, I will pass on to our Head of Investment, Matthew. So Matt, please take it away.
Thank you, Callum, and thank you everyone for joining us today. Today I'll be talking about characteristics of fine wine as an asset class, review the recent market performance and what we've seen recently, and also why we believe DRC is a good investment. So first off, the characteristics of fine wine. Well, first off, it's CGT exempt. Fine wine is classified as a wasting asset under HMRC. That means no capital gains tax for investors. And all of our syndicates are structured in this way to preserve this exemption. So every investor that gets involved in one of our syndicates or private portfolios receives a formal letter from our tax consultant confirming this CGT treatment. Secondly, fine wine is an excellent diversifier. So it has what we call a low rolling correlation coefficient to asset classes such as equities, bonds, commodities, real estate. And we don't suggest putting all your money into fine wine, no, but it's an excellent complement to a traditional portfolio. And then last time, fine wine showed solid long-term growth. So it has a unique interplay between demand and supply. One of the key characteristics of fine wine is its ability to age. And as it ages, it develops secondary and tertiary flavors. Basically, it tastes better and demand goes up. But at the same time, on the supply side, supply vintage is fixed. And then as the wines age, the supply decreases due to consumption or damage, or the wines get lost. That means whenever a wine is at its peak drinking window, it's also at its scarcest. And it's this interplay between demand and supply that drives price over time. So why do we think now is a good time to invest in fine wine? Well, if we look at the LiveX 1000, which is the industry broad-based benchmark, we can see kind of a bubble formation from the start of 2020 to August 2022. And this was the market being driven by COVID-related factors. So first off, there was an increase in the money supply. Central banks were printing money to ease COVID-related issues through furlough payments. When you increase the money supply, that also increases the price of fixed assets, such as fine wine. A cohort of individuals had more disposable income. They weren't spending their money on normal things like travel and holidays. So they had more money to spend on their passions like fine wine. And people were also drinking more alcohol over this period. They weren't able to go out and socialize like they normally would. So for entertainment, alcohol consumption went up. And these factors drove the price of fine wine. But this came to an end around August 22. Inflation rose due to the fact there was an increase in the money supply, and that caused central banks to increase interest rates. So higher interest rates are not good for the price of fine wine for two main reasons. First off, it reduces the risk premium from holding a liquid asset for fine wine. So there is capital relocation out of fine wine as an asset class. But also it increases people's propensity to save as opposed to consume, which is also not good for a consumable good. So we saw prices decrease, and we also saw the effects of COVID reverse, which is also another reason why prices came down. And the result was a 34-month correction. But where are we now? Well, thankfully, we're in this green area to the right-hand side of the chart. Prices have returned to pre-2020 levels. Forced selling has largely played out, and we're now seeing stabilization and early green shoots in the market. So it looks like an early cycle recovery entry point. So what are we looking at here? Well, here we're looking at the supply side of the market. So we're looking at the lowest list price of all the wines in our investment universe and how that's changed quarter on quarter. So we've split each of the bars into three segments. The green, there's been an increase in list prices. Yellow, prices unchanged, and red, a decrease in prices. And you can see over the last number of quarters, we've had an increase in prices increasing and a decrease in prices decreasing. So why does this matter? Well, from 2013 to 2022, prices kept going up in the fine wine market. Merchants were holding more stock than they traditionally would, as it was an asset on their balance sheet and it was an increase in value. But when prices fell, stock had to be sold, and this prolonged the correction as there was an extra dump of supply. And that's why we had a bit of a 34-month downturn, which was largely inventory unwinding. But now we're starting to see a supply side equilibrium. Okay, so what then about the demand side? Well, here we're looking at the bid-offer ratios of a number of indices on the LiveX. And bid-offer ratio is basically comparing the value of bids to the value of offers. And it's a good way of reading demand in the market. So higher ratio, stronger demand, lower ratio, weaker buy interest. And we can see across all these indices, the bid-offer ratio has been increasing over the various time periods. So 1 year, 3 months, 1 month, and to the end of Q4. They're at the highest they've been since the end of 2022. So though this quarter-on-quarter improvement indicates buyers are coming back, they're attracted by better market pricing, but they're also more confident now that they're seeing a stabilization in the market. And then lastly, this takes us on to our trade-based index. So our index only uses actual trade prices. They're wines that have traded at least once a quarter over the last 5 years, and this avoids distortions from stale list pricing. So why is this important? Well, over the last 2 quarters, we've seen an increase in the trade price index. And this is the first time we've seen this since early 2022. And this confirms what we've seen from the LiveX 1000. They're seeing a stabilization in prices. We're seeing it on the supply side of the market. Prices are stabilizing. We're seeing an increase in demand on the bid side. And this is playing out now in our trade-based model, where we're seeing prices increase from actual trade prices in the market. And for those of you that attended our Leon Wheeler webinar in August, you will have seen us hinting at this, basically this market stabilization. And we're seeing this thesis now playing out over the last 6 months. So why invest in Romanée-Conti, DRC wines? Why DRC matters? Well, it was founded in 1232 by monks of Abbey Saint Vivant, who started cultivating the original Romanée-Conti monopole. But the defining moment for DRC happened in the 1760s, when the Romanée-Conti vineyard was purchased by Louis-Francois de Bourbon. He was high nobility and heir to the French throne. And he made the wines exclusively for himself and his fellow nobility. And this was when DRC became an untouchable aristocratic wine and the beginning of the DRC brand. But in modern times, DRC has been owned by 2 families, managed by 2 families, the Domaine family and Domaine, another large Burgundy producer since 1942. And just some interesting facts about DRC. Well, DRC represents 65% of all wines traded in auction above £10,000. DRC Romanée-Conti is the most expensive wine ever sold at auction achieving $558,000 for one bottle of the 1945 vintage in Sotheby's auction in 2018. And DRC has the highest average critic score of all Burgundian producers in our investment universe, with an average critic score of 95 points. And you'll see the full list in our investment deck, which we'll provide after this presentation. So our permitted investment, well, it's the Grand Crus of Romanée-Conti. And DRC is the only producer in the world that only holds Grand Cru vineyards. So what is a Grand Cru vineyard? Well, it's the highest vineyard classification in Burgundy, which was formally recognized with the formation of the AOC system in 1937. And it identifies sites with exceptional soil, optimal aspect, and a unique microclimate, and is also based on their historical reputation to that date. And the interesting thing about Burgundy, due to their inheritance laws, is multiple domains can own sites on the same vineyard. However, there are these rare instances where one domain occupies a whole vineyard, and this is what we call a monopole. And DRC has two, and it's their flagship wines, the Romanée-Conti and the La Tâche. And what makes this so special? Well, these are two of the finest sites in Burgundy that no other producer has access to. And it's that quality and that scarcity and the brand power that really drives Romanée-Conti. So if we look at the wines, okay, we have the two Romanée-Conti, or the two monopoles, Romanée-Conti and La Tâche. Then we have the Richebourg, Romanée-Saint-Favant, Grand Echezot, and Echezot in the Côte de Nuit. And then in the Côte de Beaune, we've got the only Grand Cru site in the Côte de Beaune, the Corton, red, and then the two Montrachet, or sorry, the two whites, the Montrachet and the Corton Charlemagne. Now there is a 10th Grand Cru, and it's the unicorn wine of Romanée-Conti, and it's the Bâtard Montrachet that is just not released to the public. And that is the ultimate collector's item. But unfortunately, there's no secondary market presence of that wine, so will not be included in the DRC collection. But if you ever see one, please let me know. Okay, so what on earth are all these circles? Well, this chart shows our returns and liquidity matrix, and each circle represents a producer or a domain. And on the x-axis, we're looking at trade count. So this includes all the trades in our data set from UK, EU, US exchanges and auction houses, and it's our proxy for liquidity. And then on the y-axis, well, we're looking at mean annualized returns over the last 10 years, and it's our proxy for investment performance. And if we look at the purple shaded area at the top right, well, these are the wines that have really strong market liquidity and historic returns. And you can see in there in the large purple circle, that's DRC. But one of the things this chart doesn't show is annual production. And this is really important. So DRC, for example, every vintage that it produces makes roughly 6,000 cases. It's had 40,000 individual trades in the secondary market over the last 10 years. And its annual CAGR is around 12%. If we then compare that to the wines of Dom Perignon, whose production's roughly 50 to 100 times larger than DRC, yet secondary market trading volume's less, and also annualized returns is less. And then if we look left again, maybe not so clear, but you can see lines highlighting a number of the first growths. First growth production, again, considerably less than DRC, 10 to 20,000 cases of vintage, and less returns. And why is this important? Well, DRC has such strong global brand power that it has this unique fundamental about its wines, that it has really, really good secondary market liquidity and consistent returns. And the reason for this is, well, firstly, is extremely difficult to acquire in the primary market, so which has created a larger secondary market presence. But secondary, it's the global brand power of DRC, where demand outweighs supply. And then the last slide here, we'll go into a little bit of investment geekiness, but here we're looking at three kind of indices. We've got the wines of DRC from 1995 onwards. We have the producers of the Burgundy 150 index from 1995 onwards, X the wines of DRC, and then the producers in the LiveX 1000 index, X DRC. And we can see here that lifetime CAGR, so annual returns for the wines of the DRC, is higher than the other two indices. But then I'd also like to look at the current drawdown. So drawdown is the difference from the previous market high to the current price. So we're looking at October 22, the current market price. And Domaine, the DRC wines have decreased the most in price. And what we say about DRC wines is they have a relatively high beta. So when markets underperform, they tend to underperform the market by more. But when they outperform the market by more. And that's also identified by, okay, it's a higher drawdown currently, but also has a higher lifetime CAGR. And why that's important now? Well, if we go back to the kind of market timing slides and a review of recent events in the fine wine market, it looks like we're in a stabilization process with green shoots of recovery. And it's wines like DRC with that kind of beta profile that tend to outperform when you use that market timing. Okay, so is there any questions so far?
Nothing in the chat as of yet, but if anyone does have questions, please feel free to ask and we'll pick them up as we go along. As I mentioned at the beginning, we'll also do a Q&A at the end.
No worries. Well, I'd like to then pass on to Aaron.
Do we want to answer the question from Oscar, or should we save them?
Sure, let's answer it now. We've just made the offer. So Oscar has asked, how do we source the wines, or do we already have them for this syndicate, presumably?
So firstly, how do we source the wines? We work with a large number of trusted merchants, and we use exchanges as well. And do we already owe them? We will buy some wines ahead of the closing of the syndicate, but the majority of our purchases will be made after the cap raise. And we'll begin sourcing the wines then over a 2 to 3 month period after that. The reason why is we want to reduce timing risk instead of buying all the wines at once. And also it gives us time to take advantage of better market deals.
And it allows us to tailor the portfolio to how much we actually raise for the syndicate. Great. Aaron, over to you.
Great. Well, thank you very much, Matt. I thoroughly enjoyed that. And that's coming from someone who gets to see you every day. And I will forgive you for calling my section the geeky part. I will try to make this as not geeky as possible. So I'm going to talk a little bit about our data and asset selection process in particular. I am Callum, as Callum said, I'm the head of data here. And really my job can be summarized as using data to select the right assets for our clients. So why is that important, and why is data-led asset selection important? So not all investment-grade wines are created equal, and not all investment-grade wines present equal investment opportunities. And that is true even within DRC itself, and especially true in the modern-day fine wine markets. So here you can see a plot of the difference, quite a big difference between the mean returns of the top performing 50% of DRC wines and the bottom performing 50% of DRC wines over the last 5 years. So that's a 52% spread, and it's pretty significant. And obviously, in light of this, being able to analyze the opportunities at scale and select wines for investment that are most likely to appreciate and outperform the market, and also buy them, crucially, at the right prices, because those are the two key elements to sourcing well at scale is really important. So my job and in the data department here, our job is to identify these wines as well as we can before the fact. So I'm going to talk a little bit about how we identify these wines. This is a very involved process that I tried to condense down as much as possible. So we basically are testing theories on how can we predict which wines will be those that outperform the market, that create alpha, and implement those theories at scale? So what we're really doing is finding and building variables that are predictive of future outperformance. And those might be ideas that come from within the team. It might be common wisdom within the fine wine markets. And we look at every investment period in history and see which of these variables have proven consistently to be predictive of future returns. So these variables are quite a bit more complex than, say, just critic scores alone. But to use critic scores as a simple example, in recent history, critic scores, of course, play a massive role in our modeling. But the raw score in recent history, for example, has actually proven the higher it is to be negatively predictive of alpha. So we've seen in recent years, whereas it might have been true in the past that over long investment periods to buy 100-point wines early in their life cycle would have outperformed the market mean. Now we actually see that element being priced in, and merchants using high scores in some cases. This is never a hard and fast rule, to justify higher entry prices, which reduces returns, especially over shorter holding periods between, say, 4 and 7 years. So that's just one example. And then once we've created all of these variables and included them in our modeling, we basically perform a ton of simulations to see how would this modeling have done in the past, and that is what I'm going to dig into a little bit now. So it's all well and good to have found all these variables, and built a model, and we call it our WIS model, which is the WineFi investment score, that essentially ranks wines from 0 to 100 based on their likelihood to outperform the market. Once we built that score, how do we know it's working? And this process is called backtesting. It's our historical backtesting of our asset selection model, aka the WS score. And what we do is we pretend it's a point in the past. So say in this example, it's 2020. We hide all of the future data from our modeling, and we train our regression models on each of the predictive areas we've identified to optimize their weightings based on historical trends. We use this trained model, which only knows everything up to 2020 as if it was 2020, to make WIS scores for the full universe of investment grade wines. And then it's as simple as checking how well our predictions did versus the actual returns over, in this example, the next 5 years. And we repeat this process not just for 2020, but for every year, in our case from 2009 onwards, to make sure that our model is performing consistently over time, consistently over market conditions, and is optimized for not just trends that were temporary, but is robust across time. So you can see in this plot here, this is an example simulation of when we set a WS score minimum, I think, to 60, and portfolios of £100,000. I think the syndicate, we like to keep it on the lower range, because then it represents, especially in a syndicate like this, the more risky example, and we're stress testing the model a little bit more. And we always will be leaning towards the more cautious approach from the data front. And we set a minimum score in this case, I think, of 70, a WS score of 70, and then simulated a ton of portfolios to see how did those perform over a 5-year hold period versus the benchmark. And you can see here that there's consistent, significant outperformance, with the mean being significantly above, in this case, the regional benchmark, which would have been the LiveX 150. And that's it from me. So shall we move on to questions?
Yeah, absolutely. We've had one come in, and apologies if I'm mispronouncing this, but from Dada. She has asked where we collect our data from, or our different sources.
We have data from a ton of different sources, and you can probably split it into listing data, so offers for wines, trade data, transactions for wines, and then the whole world of critic data, and of course bids and other sources of reviews. We get our data from a mixture of proprietary sources and aggregators like the LiveX and Wine Decider and Wine Labs. And we intentionally get data from multiple sources to cover all of our bases and allow the aggregators to sense check one another. So if we see an unusual looking lowest list price, we can look at other sources of the data and verify, and Wine Searcher, I forgot to mention as well, and verify where that's coming from. So everywhere.
We've had a couple of people from LiveX join the call, so I'm glad you gave them the shout out they deserve there, Aaron. Do we have any further questions on the presentation or the business or anything more general? Good question. Why offer a pure DRC syndicate at all when each bottle trades independently and a selectively curated portfolio could, in theory, deliver higher returns? Matt, Aaron, would either of you like to take that question?
Sure. Well, it's like putting all your eggs into one basket. Yeah, you may pick the one that outperforms, but you've also increased your portfolio risk significantly. So what we do, and Aaron can add a bit to this, with the WIS modeling and why actually a syndicate is a really good method here, is returns are more consistent in larger portfolios that are diversified. And that's one of the beauties of the syndicate model as well. You're getting access to a fully diversified portfolio for a fraction of the entry cost.
Yes. So just to add on top of that, I think that my interpretation of the question is basically, why would we invest in just DRC when we can invest in a diversified portfolio of all wines? And the truth is, this is a distinct investment opportunity compared to other syndicates that we do run and will run in future that are say regionally diversified or across a basket of producers. This is saying we have a thesis on DRC and it's higher risk than diversifying across multiple producers and multiple regions, but the potential reward could be higher. So that's why we think it's the right time to focus on this producer, and it's for those that are willing to go for that slightly higher risk, higher reward approach.
Yeah. Okay, yes. Well, so I'll tread carefully here because clearly this is an ongoing issue. But based on publicly available information on their website, the first major issue that they have encountered is that they have not segregated, by the looks of things, their clients' wines. I believe the wording of the trading standards notice on the website mentions that only 20% of wines are actually within client accounts. We have, since inception, ensured that our wines, both for our private portfolios, so portfolios entirely owned by an individual, and those owned by syndicate members, are clearly identified and legally segregated within Coterie Vaults, which is our third-party storage provider. We are actually able to provide a letter of attestation from Coterie Vaults, so from a third party to that effect. And there is a third-party point of contact at Coterie Vaults at a senior level that you would be able to confirm that with. So you don't even have to simply take WineFi's word for it. You can confirm it with a third party. I hope that answers that question. But of course, that is critically important. Any further questions? And I was anticipating a question like that on this particular webinar, so I'm glad it's come up early. Great. Well, if I appreciate people might be thinking of questions. So Aaron, if I could ask you one. In fact, we've just had one come in. I understand why you would offer different investment portfolios specialized on particular regions, just like any investment, but wouldn't it be wide to include other sought after Burgundies? For example, Richebourg or Rousseau wines, where demand might behave simultaneously. Matt, one for you.
So interesting on, I mean, Rousseau and Gevreux Richebourg, very, very top producers. Kind of bring back to that liquidity slide that we showed earlier. DRC has this unique combination of high liquidity, high returns. And where that's also important, and we didn't talk about it, but it's a great factor, is the exit of DRC and the secondary market of DRC on the way out makes it a very compelling investment case. So as Aaron said a minute ago, we have done, so for example, we've two Burgundy syndicates, which would include both the wines you mentioned there, both the producers you mentioned there, have However, this is a specialty case on DRC for the reasons that we mentioned in the presentation.
Yeah, fully agreed. I think it's also probably worth touching on the fact that all of our syndicates are thematic. So they might be based on a certain investment strategy. They might be regionally thematic. So we have run, as Matt alluded to there, again, creatively named, but the Burgundy collection and Burgundy 2, which was the second iteration of that particular strategy. This one is thematic, but around a single producer. You mentioned that fine wine is often exempt from CGT. Does this apply to everyone in the DRC syndicate, or are there any nuances that we should be aware of? There are nuances. So as Matt alluded to, fine wine is exempt from capital gains tax in many circumstances under HMRC's wasting asset allocation. All syndicate members are provided with a letter of recommendation from a third-party UK tax specialist to that effect that they can share with their own advisors. But it is worth mentioning that we only provide that for UK investors, and the tax treatment of fine wine varies considerably internationally. It might be of interest to some people listening to understand why we use the phrase "in many circumstances." The way that HMRC approaches it is that the wine must have a useful life, so based on drinking window, a predictable useful life of less than 50 years. Now, whilst that would include all wine within WineFi portfolios, specifically because we select wines that fit that criteria, it wouldn't include fortified wine, so port, for example, which often surprises people, or certain sweet wines like Chateau Yquem, for example, that can be preserved for 100+ years. So hopefully that answers that question, but it's why we provide a third-party letter of recommendation. What happens if Reeves removes this? Will you liquidate the portfolio ASAP? I mean, Matt, maybe one for you on liquidation, but if Reeves removes this, the tax treatment of fine wine will change. I intuitively don't understand why we would liquidate the portfolio ASAP, unless it was to try and catch the CGT prior to the changes being implemented. And I imagine that would depend on performance, but Matt, I think you're probably best placed to elaborate on that answer.
I mean, there's been no indication that would happen. If it did, and we started to see a material impact on the cost of the wines, we would recommend a quick liquidation, but we would have to see what the actual impact on the wines were if that was to happen.
Yeah. Any further questions? I have a question for you, Aaron, that you alluded to, but I think is quite interesting, which is around the right time to buy wines. And I know we've done some specific work on Burgundy and more globally on that front, but a lot of people listening who perhaps have bought wine through a merchant in the past, or perhaps just into wine, will often have heard that the best way to quote unquote invest in wine is to buy young and hold for the long term. Buy at release and hold for 10-15 years. Obviously, the anticipated holding period for this particular syndicate is 5 years. So can you talk a little bit about why our approach differs? Because I think it would be interesting.
Yeah. So there's a few parts to that. One is that historically, and the commonly passed on advice has been to purchase wines very early in their life cycle or on release during en primeur. But we've found in our data, especially recently, that en primeur is becoming like investing in a company at an IPO. It could plummet as the market decides that actually that price was not where it should be, and frequently that has happened, especially recently. And actually, we find that on average, the best time to invest in wines is closer towards the start of a drinking window, and actually persists pretty well during the drinking window. It doesn't flatten out as much as many people say it does. And we see another spike towards the end of a wine's drinking window on average. And these drinking windows differ significantly across regions. They differ significantly across producers and even can be ranked based on the scorings of the wines. But our goal isn't to invest your money for 15 years and hope that we capture during those 15 years the best period in terms of appreciation of that fine wine's life cycle. Our goal is to buy the wine at the period where it's going to have the best appreciation during its life cycle. So that's why we can and do focus on shorter holding periods. I don't disagree that if you hold wines for a significant, 10 to 15 year period of time, you can have strong investment performance, but I would push back that you're just allowing time to capture something that can be identified more accurately through data.
Thank you very much. Do we have any final questions in the chat? So we've had one from Andrew. We talked about institutional grade data. How does this specific selection of DRC pass our screening process? I know you touched on that, Aaron, but do you want to expand on that question?
I'm not sure I understand institutional grade data part of the question.
Meaning, I guess, the rigor of the approach. I assume that's the case, Andrew. So please correct me if I'm wrong, but yeah, go on.
So yeah, well, our committee obviously are there to pass a qualitative lens over everything we do. That our committee ranges from experienced fine wine investors, with 30 plus years, who have seen it all in the industry, to one of the leading academics in fine wine. So depending on the committee member, they're screening for different things, but they'll sense check, are the things our model outputting actually making sense? And actually, they will, to touch on your point on institutional grade data, will actually check the kind of this pricing looks strange to me. Can you tell me if it is strange or if it's actually true? So they will go down to that detail with us. And then on the academic side, we're actually checking the academic rigor of our modeling. If we built this model that, for example, is designed to explain the movements of the fine wine market, have we done it in a rigorous way, and have we done the necessary robustness checks, for example? So yeah, there's quite a bit that goes into the kind of screening from our investment committee.
Yeah, I think that's an important point to make as well, because I think that because we talk about quantitative analysis quite a lot, because we understand that it is a bit of an edge for us and a bit of a USP as well. We do have that qualitative overlay. So there is, an experienced human or humans in the loop when it comes to reviewing our portfolios. Any final questions before we wrap up? I will assume not, but usually one comes in just as I am wrapping up. So if it is, then we'll go back. But thank you so much to everyone that attended this webinar. We will be in touch afterwards with a recording of the webinar and the deck itself, along with an overview of this opportunity. Our target close date for this particular investment is the 8th of March, but we have a fixed limit in terms of the number of syndicate members that we can welcome in, and we are already 80% on target. So if you do want to get involved or find out more, please get in touch. We would be happy to take a one-to-one call or send over any further information that you need to make a decision. I hope this webinar was insightful. I learned a lot. Thank you, Matt and Aaron. And thank you both as well for taking the time to prepare the presentation. Thank you, everyone, and have a great rest of the day.
Thanks, everyone.